Hey, good day, everyone. Bert Salazar here. We're about to go live on Facebook, and I'm in the process of doing this right now in order to do the Bert Salazar Retirement Show, which is the only one on Facebook Live. Let me choose the page where I want this to go to, and it will be my Gables Tax Planning Group page. And let's see if we can connect. Last week, we were fine in doing it. So once again, just bear with me a few seconds as we're connecting to Facebook Live, and hopefully is coming through right now. So we'll see. And let me just go live at this point in time and go live anyways. Okay, perfect. All right. Awesome. So we should be about ready at this point. So just give it a couple more seconds, and I'm excited to be here with you today because I'm going to be sharing a lot of good information with all of you. And there we are. We're actually live on Facebook Live. So once again, Bert Salazar, and I'm the host for the Bert Salazar Retirement Show, which is, by the way, the only retirement show on Facebook Live based on all the research that I've been doing in the last several weeks. So for those of you that are watching, I would appreciate if you can hit like, if you can share, if you can make some comments. I'm by myself, so I may not be able to acknowledge you, so I'll try to acknowledge you at the very end. But once again, I'm excited to be here. And I want to talk a little bit about basic economics. When I was in college, going through my accounting major and so forth, obviously I had no choice but to take Economics 101. And I think it's important because a vast majority of Americans do not understand economic principles. One of the things that I normally say to a lot of my clients, and many of you in my online community, when you call me and when you see some of my videos and so forth, I always say that methods are many and principles are few. Methods are always changing, but principles never do. So if you understand the principles of economics, the principles of finance, the principles of retirement, which is my specialty as a tax planner and a retirement strategist, and obviously you can understand where I'm coming from. Now, what's interesting is that no one is having this conversation. I jotted down some of these notes, and it's important that someone starts to have that conversation with all of you. Yesterday, I went ahead and I did a video which is going to go online tomorrow. Is called How to Rope-a-Dope Your Retirement Account to Success, or Your Retirement to Success. And it brings back memories. For those of you that have been around for a long time, you understand, you remember the greatest of all time, Muhammad Ali, and how he used the ropes in order to create a false sense of security on his opponents. And he would rope-a-dope them, like just going against the ropes and just sitting there taking punches and trying to block punches and so forth. Now, he did take a lot of punches, but he won a lot of fights. And the reason why he started using the rope-a-dope was that he was getting older, and obviously he was slowing down, and he was fighting young kids and boxers that were coming up the ranks, and they were hungry. So he needed to figure out a way to beat them. So, but I'm not going to go into that. You can watch that video. And then how do you take the rope-a-dope of Muhammad Ali and make that into an analogy for your retirement and your retirement distribution planning? So it's important that you understand that as well. Now, when I'm talking about Economics 101, there are a number of things that are important for each and every one of you to start paying attention to. Number one is the impact of taxation on retirement assets. Many of you are not paying attention to that. And because of the fact that you're not truly paying attention to that, because most Americans and most of you watching this Facebook Live retirement show today, do not like to go through pain today. You rather delay that pain, even if it's going to be greater at some point in time in the future, because the pain of taxation is not as painful today as it's going to be a few years from now, especially when we hit January 1 of 2026, when taxes are going to be higher, because the current tax law is going to go away and sunset December 31st of 2025. And who knows who's going to be in power at that point in time and what they're going to do to the taxation here in our country in order to pay for the mess that we seem to be in today, and getting deeper and deeper into it every single day. So if your retirement accounts are dormant and you're not doing anything, and this is part of the video that I'm going to be putting out tomorrow, then chances are you're being rope-a-doped by the IRS, the government, and financial institutions along those lines. By the same token, it's important that you understand the impact of inflation on your retirement assets, because, as you know, inflation is the silent killer. It's all around us. You can barely see it, but except if you go to the supermarket or to the stores, you know, to buy goods and services, and you're going to see that inflation heating up. As a matter of fact, at a 3% rate, at a 3% inflation rate, in just over a 20-year period, you're going to lose 50% of the purchasing power of the assets that you have today. In other words, you know, if you make $100,000 today, in 20 years from now, that same $100,000 is only going to be able to purchase $50,000 worth of goods and services. The other thing that's important for you to take a look at is the impact of the lack of risk management on your retirement and on your retirement assets, and also in your retirement life. So the fatal four, as I always call it, the risk of dying too soon, living too long, living with a disability, and living with eroding factors like taxes, inflation, stock market volatility, interest rate volatility, propensity to consume, and all of those issues that are so critical to retirees. If you don't have a proper strategy to deal with the fatal four, chances are you're not going to have a very successful retirement life, neither you nor your family for that matter. So I think the question is, what are some of the things that we need to pay attention when it comes to Economics 101? And listen, you can take an economics course, you can take it online, you can download an ebook from Amazon that, you know, on Economics 101, because the more you understand how money works and how money flows and the economics of life, the better prepared you're going to be in order to make the right decisions at the right time for the right reasons and under the right circumstances. So one of the first things I want to share with you is that the IRS is the CEO and the CFO of all your retirement accounts. You cannot do anything pretty much to your retirement accounts without the consent or without the penalty of the IRS and the IRS code. So whether, you know, they're going to tell you when you can put money in, how much money you can contribute, how long you have to keep that money there, what would happen if you take money prematurely, the penalties that you're going to have to pay, the window of opportunity that you may have where you have a little bit more flexibility, and then required minimum distributions at some point in time in the future that the IRS is going to govern on your behalf and on all of us that put money away in retirement accounts. So in reality, they're the CEO and the CFO of all your retirement decisions. The problem is that most of you think that you own your own retirement accounts. And in reality, all you're doing is making contributions to a retirement account, because the IRS is going to dictate just about everything else that you have along the way. And unless you know how to properly manage those retirement accounts, it's going to create all kinds of issues and concerns for you in retirement that I cover in that video yesterday that I did on the rope-a-doping of your retirement accounts to success. I had some oral surgery a week and a half ago, so I have a little plate underneath my mouth. So I'm sorry if I have a lisp. It's not that I'm trying to create a new accent for myself from that perspective. So understanding that is very, very important. Now, what can you do if you want to not be rope-a-doped, and you would then force the IRS to be rope-a-doped, where you're going to be the aggressor, you're going to be in total control, and so forth? Well, you know, the first thing that you need to do is you need to create a a tax straddle the sign. And it's important to know that there's a big difference between compound interest and compound tax. And this is where Economics 101 comes into play. Now, if I were to ask you, would you rather have compound interest or compound or simple interest, what would your answer be? I would imagine all of you are going to choose compound interest as opposed to simple interest. And the reason for that is the benefit of compound interest is that your account value is going to increase much more rapidly because it's interest compounding on interest, which makes all the sense in the world. And that's important to note, especially when you're investing in retirement accounts where the money that you put in goes in pre-tax, the money grows tax deferred and compounding at the same time. But then when you pull the money out, you have to pay taxes on the whole thing. Now, if I were to say, okay, since you like compound interest instead of simple interest, then you would probably like compound tax instead of simple tax. And you're going to say, no, Bert, time out. Wait a minute. I told you I like compound interest, but I would not want compound tax. I only want simple tax. And obviously, if that's your answer, then I agree with you totally. The problem is that in all retirement accounts, you cannot separate both. So you have compound interest, you also have compound tax. And the compound tax is actually depreciating the value of your compound interest account, because at some point in time, you're going to have to pay taxes on that. And the taxes is compounding at the same rate that the interest is compounding. And that tax will always belong to the IRS. So always remember that if you put a $10,000 into your 401k this year, and you were in the 30% tax bracket, if you did not put that money into a retirement account like a 401k, then you would have paid 30% in taxes, and then you could have invested the $7,000 net. So obviously, most people say, well, Bert, if I put $10,000 into a retirement account, my account is going to grow faster, and I'm going to have a lot more money at the end. And the answer is no. You're going to have the same as long as you remain in the same tax bracket, and everything else remains equal. And the reason for that is that, the fact that you put 10,000 instead of 7, basically what the IRS did for you is they gave you a loan for $3,000. They allow you to do to use their money, and instead of them collecting the tax right now, they're actually investing and hoping that you will do well with that $3,000 that they loaned you, so that money can continue to grow also on a compounding tax basis. So when it's time to retirement, obviously you're going to have to pay taxes on the same amount. The only time you're going to be ahead if you invest this in a retirement account is if when you retire, your taxes are going to be lower than they are today. And unless you've been a total financial failure, or unless you've done proper tax planning, which most of you, I would argue, have not done that, then the probability that you're going to be in a lower tax bracket at time of retirement is going to be slim to none from that perspective. So I'm going to give you an example of how it is that you can take a compounding account and move it in such a way that instead of having a compound interest, you're going to have a simple interest. Let's say that you have $100,000 in an IRA, in a 403B, in a 401k, any type of retirement account. And let's say you're already over the age of 59 and a half. And in 1 year, the account earns a 5% rate of return. So that means that $100,000, now your account value on a tax deferred basis is now at $105,000. So if you let that money grow, then the following year, whatever rate of return, let's say you get another 5% rate of return, that 5% rate of return is not going to be on 100,000, it's not going to be on 105,000, because your account value is also compounding. So you have the compounding interest effect on your account value. But by the same token, your taxes are compounding, because when you start taking the money out, you're going to have to pay taxes to the IRS based on your tax bracket. And even if you were making a little bit less money in retirement, which you're hoping that you won't, that you're going to be making at least the same, also remember that many of the deductions, exemptions, and credits that you were using prior to retirement, you're not going to be able to use anymore. So therefore, your taxes may actually go up because you lose a lot of those deductions that are so critically important for you, but are not going to be available at time of retirement. Now, what if in the first year, when your account value went from 100,000 to 105,000, you took the interest that the account earned out, you pay the tax. So if you're in the 30% tax bracket, you paid the IRS $1,500 in tax. And then you take that $3,500 and you put it into a tax-free account. That could be a Roth IRA, that could be a Roth 401k, that could be a municipal bond, that could be a 7702 plan, which is a cash value life insurance plan that many of my clients use as a supplementary retirement plan. So you're actually shifting that $5,000, pay the tax now, and then obviously put that money into a forever tax-free account inside of the tax-free IRS code bucket that we all have available to us. Now you have a net of 100. Then in the next year after that, you still earn another 5%, and you do the same thing over again. So you're only paying a simple tax on those $5,000 that are growing in that account every year. And then you're netting that out and putting that money into an account where now that value is going to compound. Now you're going to have into that tax-free bucket, you're going to have compound interest, but you're going to have zero tax. So now the compounding effect is actually working on your favor as opposed to the IRS. Now, there are many different ways that you can do that, but most of you have not thought through it. So what you want to do is you want to limit the taxation on the 100,000, because if that 100,000 continues to grow inside of that tax deferred account, then your taxes will continue to grow along those lines, and that's not what you want. In addition to that, the minute that you start shifting that $5,000 somewhere else, or the net of $3,500 after paying the tax on it, or $4,000 depending on your tax bracket, now that money's growing tax-free for you. But most important, now you have full control of when to take that money out. The IRS is not going to obligate you to take money out of those accounts unless you want to. So now you're taking a lot of that control away from the IRS, and you're using it to your benefit along those lines. Now, always remember that you can only control your taxes today. And we only have a 6-year window between now and the end of 2025 in which you want to maximize all of your tax benefit, because who knows what taxes are going to be in January 1 of 2026. Well, I already know they're going to be higher because the tax brackets are going to go up and your standard deductions are going to go down. So therefore, all of us are more than likely going to be in a higher tax bracket in year number 6 from a taxation standpoint. Now, another thing that's important for you to understand from an economics perspective is that a guaranteed paycheck has a higher intrinsic value than a non-guaranteed paycheck. And that's a fact. So if you're giving the same way that I gave you an opportunity to choose between compound interest and simple interest, and choose between compound tax and simple tax, if I were to ask you, would you rather have guaranteed paychecks in retirement or non-guaranteed paychecks in retirement, all of you are going to choose guaranteed paychecks in retirement. The problem is that the IRS is rope-a-doping you, and the institutions are rope-a-doping your retirement assets, and they're the ones in control because you're not thinking outside of the box. Because when you have guaranteed paychecks in retirement, then your retirement life is going to be a lot more fulfilled. It's going to be a lot better. You're going to feel a lot happier. Your family's going to do much better. And all you have to do, like I always say, is to wake up on the green side of the grass, and everything is going to be good for you along those lines. So I think another question that I have, now that we've talked a little bit about the basics of economics and some of the issues in Economics 101, and I have a laundry list of those, but I'm not going to cover them. But these are the basic ones when it comes to guaranteed paychecks and the compounding effect of your assets and the compounding effect of taxes in retirement. But now the question is, how do you truly obtain financial freedom, which is something that all of us want to have at some point in time. And the sooner you get to have financial freedom, the better off you're going to be in life, because there's a difference between working or running a business because you want to, as opposed to working and running a business because you have to. It's a big difference between the two of them. So number one is by creating guaranteed paychecks for life. And that's something that I just talked to you about. If you're able to create put together a self-created pension in which you can have a guaranteed paycheck for life, then obviously you have financial freedom, because now you're going to have the flexibility, the liberty to be able to do with the rest of your retirement assets things that you couldn't do before because of fears of running out of money before you run out of life, because you may live a very long life in retirement, maybe even 3 or 4 decades, depending on when it is that you're going to be retiring. The second thing that you can do to obtain financial freedom is to also create guaranteed tax-free paychecks in retirement. So if having non-guaranteed paychecks is not a good thing and having guaranteed paychecks is a really good thing, what about if you can have guaranteed or tax-free guaranteed paychecks for life? That would even be better. That would be icing on the cake. Again, if you do proper tax planning and you're able to manage all of your deductions and exemptions and credits, you can actually create guaranteed paychecks for you and your life and your family that you cannot outlive for the rest of your life. So that's important to know. What else can you do to obtain financial freedom? This is a big one. This is creating monthly cash flow prior to retirement. See, most of the clients that I engage for the first time, most of my online community, when many of you reach out to me on a weekly basis, you're always putting money away so that money can grow tax deferred, so that money would be available for you at some point in retirement. So you have a delayed gratification, if you think about it from that perspective, that you hope to get to retirement safely and healthy enough so you can start to enjoy that money. But I always say to my clients and my online community that tomorrow is promised to no one, and no one ever dies at the right time. So you have to make a paradigm shift in the way that all of you think and start creating guaranteed cash flow for you right now. Don't wait 5 years, 10 years, 15 years, 30 years from now. Start doing it today. So I would recommend that many of you start saving some money, put it into a traditional savings account. If you don't want to pay taxes, then put it into municipal bonds and start building enough equity in those funds so that at some point in time in the future, you can buy a piece of property. You can buy some rental real estate. I remember now when I first bought my rental real estate property, my goal was to have a cash flow of $250 a month. Now that doesn't seem like a lot, but it's actually an extra $3,000 of cash flow on an annual basis. Now today my cash flow is a lot higher than that, but what if you start thinking of ways, because if you're employed or if you run your own business, you're trying to create guaranteed cash flow that you can enjoy today. But what about if you can invest into some rental properties? Some of my clients are into flipping, so they buy old homes, they repair them and then they sell them at a profit, and they do this on an ongoing basis. So you can do that as well. But I do have a lot of clients that have rental properties. They have duplexes, triplexes. They have small apartment buildings in which they're building that cash flow on an annual basis, and from time to time they sell a piece of property and they pick up another one because they're able to pick up another 15-20% on a cash flow because of how the property was structured when they bought it. So you got to start thinking about creating guaranteed cash flow today, because if you're able to get your money work for you as soon as you possibly can, the more financial freedom you're going to have for the rest of your life, and it's important that you do this as well. Another way to buy financial freedom and this I truly mean because I've been in this industry for 30 years, is buy as much life insurance as you possibly can. Because life insurance gives you the ability to spend down a lot of your other retirement assets while increasing the distribution rate in your retirement accounts. Because as you know, when it comes to retirement distribution, it's no longer about the accumulation rate, it is all about the distribution rate. So it's important that you understand how that works, and that you're able to maximize that opportunity from a business perspective. So buying lots of life insurance is excellent, because basically you're buying dollars at a discount. It's like buying, it's like money in escrow, and escrow closes when you die. But life insurance serves many other purposes, from supplemental retirement plan, where you can pull the money out tax-free and use it as a supplemental retirement plan for you and your family. You can use it as a way to offset living with a disability, the risk of, one of the fatal four, the risk of living with a disability, long-term care issues and so forth. So now neither you nor your family have to dip into your existing retirement assets in order to take more money out to offset additional health insurance expenses and health expenses in retirement, because you have life insurance that also serves as a long-term care vehicle for you individually and for your family, depending on who owns the contract. So that's important to note. Also, you may want to, if you want to obtain additional financial freedom, you should be investing in assets that are either non-taxed altogether, and we have already talked about those, Roth IRAs, Roth 401ks, 7702 plans, and municipal bond funds. Now, that's going to be delayed gratification because of the IRS rules. But you may, if you are maxed out on that and you still have additional assets, then I would invest in capital gains type assets, as opposed to ordinary income assets. Because, when you invest in assets that you're going to pay ordinary income taxes on, then obviously the tax liability is going to be greater than if the assets were based on a capital gain, where you sell a stock or you sell a piece of property at some point in time. And for many of you, you may be in a 0% capital gains taxes. And at the worst case scenario, you're probably, most of you on this retirement show today, is going to be somewhere around the 15%, as opposed to the 20, 25, 30, 35% tax bracket in retirement. So if you have to pay taxes, I would rather you pay them at a capital gains rate than at ordinary income rates. So when it comes to my retirement show for all of you is, my goal is to provide you with education. Because I can provide you with information every single day of the week, but information without education always, always, always is going to lead you to failure. So you have to be able to get out of your own way. You have to be able to start looking at your financial decisions and your finances through a telescope as opposed to a microscope, because a view is going to be totally different. Some of my clients now, that I have engaged in the last couple of months because of what has been happening with the market, have come to me and have asked me for different options, and I have given them a number of different options that they can use in order to minimize their tax liability in retirement. And when you do a tactical retirement blueprint, then you're setting yourself up for total success in the future. The sad part about it is that most of you don't even know what a tactical retirement blueprint is, and you're just following the rules of engagement that the IRS, the government, and financial institutions have created for you, in which there's no way that you can win. Because while the IRS and financial institutions and the government is playing chess with your retirement assets, you're just sitting there playing checkers, and there's no way you're ever going to win that game unless you make a complete paradigm shift and you start looking and learning about economics 101 from a business standpoint. Now, for those of you that may want to reach out to me in order to pick my brain about any of the items that I discuss and all the videos and the podcasts that I do on a weekly basis, please feel free to do so. You can reach out to me at area code 786 766-1042. Feel free to also send me an email at Bert, B-E-R-T, at bertsalazar.com, BertSalazar.com. And always remember that my goal for this retirement webcast and this retirement show on Facebook Live and everything that I do for each and every one of you is to kind of help you and your families, kind of change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, thanks very much for giving me a few minutes of your time. I don't have the time today to kind of answer any questions that you may have, but please don't keep me a secret. Make sure that you share my content and that you hit like and make some comments, because at the end of the day, the more people that I can provide assistance to, the better off we're all going to be. So stay safe, stay healthy, and I'll see you again next week. Take care. Bye-bye.